Alright guys, so here is the actual article from Medium, and again the reference, I'll post the link below in just a bit, but this actually gives you a better idea for something that I found to be very useful. So first I'll give credit to Felipe Pereira here. He's a partner at Paradigm Capital and co-founder at Parity. Basically what it comes down to is this idea of some crypto native indicators to determine cycles, and I'm gonna go ahead and comment on a couple of these. But the first point is this idea of Bitcoin, right? So Bitcoin basically has a lot of features that gave it a lot of value, and this value provides it with a lot of cyclicality to it. So for example, we do know that Bitcoin has two parts, one called a monetary policy, which basically is the replacement for fiat thesis, the anti-fragility of it, meaning that what about it that allows it to withstand a lot of these shocks to the system. So I'm going to focus here on this monetary policy because that's what everybody really understands and how that kind of plays a role in the overall indicator and cycle that we're in right now. First one is that Bitcoin is a very credible piece. It's got a P2P network that allows people to transact back and forth, and that's one of the fundamental reasons for owning it versus something like fiat, and that actually came about from the depths of the financial crisis back in 2009. It also is a proof of work, which means it's definitely has a very good case against inflation, unlike fiat currency, which basically you can print out as much as you want. And the last one is that it has a fixed supply, which basically falls under this idea of proof of work. So pretty much in order for you to get Bitcoin, you have to invest resources going in. So there's a couple of metrics that you could use to measure the valuation and also the trajectory of these cycles. And depending on where you're at in the cycle, you can almost kind of predict what's going to happen next as these levels begin to kind of get worked off. And I find this to be a much better exercise than trying to time prices using technical analysis, which I do in my channel. But that has a use case in certain markets. Like, for example, in a bull market, technical analysis is a very good part. And just because you have a lot of momentum in a bull market, technical analysis actually plays very good because it gives you a lot of the psychology that goes in. But in a dead market like right now, where you don't really have momentum, you don't have volatility, TA is actually very useless. So people who try to do TA at this point are basically just kind of wasting their time, unless you're day trading for like 5-minute charts or 1-minute charts. It's almost a lost cause at that point. So my idea here is to try to extrapolate major trends that will last for at least a year or two and ride those trends and employ a very deep fundamental and technical analysis as these markets begin to enter into their bull market. But in order to do that, we have to explore this piece real quick. All right, so the first indicator is going to be called aggregate security spin. And this is basically where people have been using market cap as a way to predict like for what stocks are, like for example, small cap, large cap stocks, and then trying to find out, multiplying the share price by the actual volume that you have. The only problem with this is that market cap really doesn't show demand, because what it does is that if somebody can print 1 billion coins and you trade it for $2, you all of a sudden have a $2 billion market cap. So the fact of the remains is that some coins have inherently done this. They've blown up the circulating supply, and by doing that, they've basically moved their coins up on CoinMarketCap real fast. And because of that, market cap is really not a good indicator of a demand for a coin or the volume that's coming in, because remember, what we need to do is measure how much volume there's coming into these coins. And so there was actually a second proposal. The second proposal was really talking about the network value of these coins. And this was put forward by Nick Carter, which I'll go ahead and reference here a little bit. And basically he's saying is that in order to measure the demand for a token, you have to take a look at the resources spent by miners in order to determine exactly whether this coin is worth mining for. And he basically is talking about how much they're actually earning back from the networks they support in terms of their investments. And that's called aggregate security spin, or called thermal cap. And basically, if you take a look at this, your thermal cap basically means is versus market cap is how much money are you actually putting in and versus you actually getting out. So as you can see from here, since 2010, the thermal cap has basically risen and capped at about, I would say 1 billion at this point. Obviously, market cap is kind of sitting at about 100 billion. And so at some point, this needs to rise for this market cap to also rise. And so the idea here is that the multiplying the transactions by the price in USD, it's basically the price that they're actually going to buy this. And so the thing is with exchanges is that even if you get transactions going back and forth, that doesn't really indicate demand, if anything. And so by looking at the actual aggregate resources spent, you're going to be able to track a little better this idea of demand. So that's one idea to take a look at. Now the second one's called market value to realize value, and this is actually called MVRZ. And basically, by definition, it says realized value is not found by counting all mine coins equally at current price, but rather assigning them a US price based on the time that they were last moved. So this makes a lot of sense in terms of holders versus miners, right? So RV suggested the final layer of people's cumulative cost basis in recent history is the element center of mass, stripping out local emotions and manias on the charts. So what they're really looking for is, are people moving their coins from their wallets? Okay. Now let's take a look at this ratio over here real quick. So if you take a look back from August, so back in 2017, so at the peak, we actually had a very high MVRV ratio. And what this basically says that you're going to calculate this ratio, you're going to divide the market value by dividing it by realized value on the basis on the left. And basically what that really means is NVRVZ tells you how strongly detached from realized value the market value is at a given time. So in other words, it's almost kind of like a proxy for valuation, kind of like when you see for stocks like a PE ratio. If this MVRV ratio is very high, this tells you that the price differential between what's given right now and what people are actually attributing the holding period is actually very disconnected. So obviously our valuation points, our high points, are right here in December of 9. We also had another high point right here. And that actually told you that we were getting close to that market peak. So rather than looking at price distortions, like for example, Bitcoin 50K, 20K, or 30K, what you're looking for is a ratio that would actually tell you a little bit more about what people's incentives are when they're moving these coins in and out. So right now there's a very low MVR ratio, which basically means that it's very similar to conditions back in 2015 when there wasn't a lot of movement out of these coins. So that gives me another indicator in terms of where we are in the actual price market. Okay, now if you actually chart the MVRVZ against parabolic spikes right before that, you can kind of take a look at exactly how we are, where we are at in this one. So here's your score value of at this value at about an 8.5. In 2013, you had another one right here, and so that actually marked the 12th of December. Now, right now, we're heading into this very low range, almost close to a zero baseline, which occurred here back in 14 and 15. So if you take a look at the actual market value to realized value, you can kind of see that we're definitely in this like very, very nice bottoming out area. In fact, it could probably go into the negative here. So it could make the argument that we're technically still not at the bottom technically, but that tells me a lot that we are definitely historically it's fallen at about negative 0.5. So that tells me that once it gets underneath this red line, the actual valuation has flipped. And so this is something very, very important because generally speaking, you can overshoot on the top side and also the bottom side. So this actually portrays a couple of things. It says major divergences between price discovery at the exchanges and the steadier rise of unmoved coins. A ratio between high time preference versus low time preference, or in other words, exuberance versus acclamation. So this is actually a great indication of what happens when you're doing a ratio of these coins being moved in and out of the markets.